So I was watching a video on SOIC's YouTube channel, I think this was last month, and everything was going fine until the point where Ishmohit said,
This is one of my favorite personal screens.
one of my favorites. So I figured Ishmohit was referring to the GARP style of investing, and to say it's one of his favorites is quite a statement which got me thinking, ऐसा क्या है यार इस GARP में? I mean, I have heard of GARP dozens of times, but honestly, मैंने कभी उसे विस्तार से समझने की कोशिश नहीं की. But that changes today, and in this video, we'll understand what GARP is, what are the foundations, the building blocks of this strategy, and most importantly, I'll take you through 4 different screeners. And mind you, 3 of those screeners came back with an absolutely shocking 1-year return of over 100%. So there's a lot to learn from this video. We have Ishmohit's blessings. So let's begin. GARP, GARP. It's an acronym that stands for Growth at Reasonable Price. It's pretty self-explanatory, but let me give you a quick background. So GARP as an investing style lies somewhere between value and growth investing. Now, if you recall, value investing as a framework revolves around looking for companies that are trading below their intrinsic value, while growth investing focuses on companies that can deliver above average growth. In fact, to draw the difference between the two approaches, while the value investor tries to understand what is the stock worth today, a growth investor is trying to assess what will the stock be worth 5 to 10 years from now. And that's where the concept of GARP investing comes in, as this style looks to combine the value and growth mindset to offer the best of both worlds. As a strategy, GARP was popularized by the famous investor Peter Lynch, and one of the most important tools in GARP investing comes from his book One Upon Wall Street, where he refers to a price upon earnings to growth ratio, which is popularly called the PEG ratio. I'll come to the PEG ratio in just a few minutes, but let's be clear on one thing. The focus here is not on finding cheap companies, but it's more on finding companies where the growth is being underpriced. It's important to understand this difference, and I'm sure this part will get more clearer as we explore some ways of implementing a GARP strategy in the coming sections. Which brings me to mStock, the sponsor of this video and one of the few stockbrokers in the country that have built a zero brokerage model. Yes, you heard that right, zero brokerage. Which means there's free intraday, free delivery, free F&O, free mutual funds, free IPOs, and a lot more. And all of this can be yours by paying an account opening charge of just 999 rupees. Yes, just 999 for all this free stuff. And if you pay another 999, then you can also get rid of those quarterly AMC charges for the rest of your life. In fact, the mStock website has this detailed comparison table, and if you're someone who is into intraday, uses futures and options, does margin trading, which incredibly at mStock can be as low as 6.99%, then definitely check out mStock, as it'll help you save a lot of money. But money isn't everything, right? Trust is equally important, and pleasantly, mStock is backed by the Mirai Asset Group, which needs no introduction. It has over 8.5 lakh users, it did over 3.5 lakh crores of turnover, and is estimated to have saved 145 crores in brokerage last year. So save it, trust it, compare it, and don't forget to try it. As always, the link to this platform is available in this video's description. Let's start with something foundational, and as you might have expected, a large part of the GARP investing framework revolves around growth, and growth itself can be looked at in 2 different ways. The first approach is to invest in companies that have grown their earnings per share at an accelerated pace over the past few years. But then let me tell you, historically, this strategy has not worked as well as one might have expected. That's primarily because a company's growth rate changes over time, and Exide Industries is a good example of that, with the company struggling to grow its earnings since the year 2019, which means earnings growth itself is a pretty unpredictable factor, and if I add the usual manipulations and biases, like calculating growth from a really low point to a really high point, then it makes up for a completely screwed up model. In fact, evidence shows that if you're going to focus on a growth rate, then it's better to give a higher priority to revenue growth, which is more sustainable and is more correlated over time as compared to the EPS growth. A second way of measuring earnings growth and something that's very integral to the GARP style of investing is to look at the PEG ratio. Now, I explained the PEG ratio in a previous video, but just to recap, it's a ratio that's derived by taking the price to earnings, the P ratio of a company, and dividing it by its EPS growth rate, that is the rise in earnings per share. To understand the PEG ratio's utility, let's apply it to KPIT Technologies Limited. So KPIT Tech is presently trading at a P ratio of 71, which as a standalone number would seem pretty high to anyone, including myself. But when we look at it in the context of a 55% growth in EPS over the last 4 quarters, then it does bring us close to the magical figure of 1, which is Peter Lynch's definition of a fairly valued business. The bigger point is that while most of our screeners would have avoided a stock that is at a P multiple of 70, by combining valuation and growth, we now have a better view, a better perspective of where the stock is and where this business is actually heading. In fact, the PEG ratio itself can be looked at in 2 ways. The first is in isolation, a bit like how we did it for KPIT Tech, and if the ratio is lower than 1, then we can consider the business undervalued on the basis of its earnings forecast. A second way of utilizing the PEG ratio is to do it on a relative basis, that is, a comparison of one stock's PEG ratio with another. For instance, it's like choosing between stock A, which is trading at a P of 20 and its profits are expected to grow by 30% every year, versus stock B, which is at an earnings multiple of just 10 and an expected earnings growth of 8% over the next few years. So this makes comparisons really easy, but having said this, and while the mathematics is the easy part, one should always account for cyclicity when examining the P ratio, and when it comes to the EPS, try to rely as much as possible on the future growth rather than the historical growth rate. In fact, I would further go on to say that since the world today is very different from when Benjamin Graham, Phil Fisher, or Peter Lynch saw it, and with the world in a generally low interest regime, modern GARP investors have become a bit accommodative and even consider a stock to be attractive if the PEG ratio is 2 or less. In addition to growth rate and PEG ratio, it's highly recommended one fortifies the GARP strategy with additional parameters like the debt ratio, that is the total liabilities divided by the total assets, should not exceed 25% as per Peter Lynch. There should be one or more powerful economic moats within the business that ensure sustainability and protection of profit margins. The promoter shareholding should be high and handsome, and we've studied the benefits of investing in owner-operator businesses in a previous video. And one should be very clear on the businesses you want to explore and the ones you'd like to avoid on the basis of your own preferences and your circle of competence. Okay, now that we have firmed up our foundations, let's get on to the main event. Now, because there is no defined GARP investing strategy, I decided to explore not 1, not 2, but 4 different variations of it, and eventually you and I can mix and match the variables to arrive at a more comprehensive framework. The first iteration I came across was a simple screener I saw in this website, ainvest.com, and it uses just 3 variables: the market capitalization, the PEG ratio, and the EPS growth rate. Now, to replicate this in an Indian environment, while the 0 to 1 PEG ratio is fine, let's change the growth rate to 20% and dial down the market cap to say 10,000 crores. This gives us a list of 39 stocks, and do notice the high sales growth and even higher profit growth, a low P ratio, and of course a PEG ratio of less than 1. Now, because I don't have the requisite software, backtesting something like this is not possible here. But as a stopgap, firstly, as a substitute to the current PEG ratio, I use the historical 3-year price earning multiple and the 3-year EPS growth. And secondly, I use the EPS of the last year and the year before that to receive this list of 83 stocks. I'm sure there are problems here, but just as a portfolio and just as an academic exercise, when I populate the numbers, I was surprised to find that none of the 83 stocks had given negative returns in the last 1 year. And what was even more surprising, or rather shocking, was to discover that as a portfolio, this concoction of companies had actually delivered a 1-year return of 113%. Yes, 113% is what this grouping of 83 companies, which includes PSUs, private banks, hospitals, tire companies, NBFCs, etc., had managed to deliver in the last 1 year. Now, I'm sure there are some viewers who are itching to write in the comments box that this performance was achieved in the bull market, and all I can say is भगवान करे आपको bear market बहुत जल्दी मिले और सिर्फ आपको उसका सौभाग्य प्राप्त हो. And this is not the only comment, right? 2 और आएंगे. So the backtesting was not done perfectly, and I can't do much about it as I don't have the capital to invest in expensive software, and neither do you. And another comment, actually, this is more of an encouragement, and thank you so much for that, which is to explore building a small case around this strategy and some other strategies which I promise to take up in the second half of this financial year. Okay, now that the scene is set, actually, the bar has been set extremely high, 113%. Anyways, let's move on to the second approach, that is the GARP framework Ishmohit revealed in his most recent video. Now, because that video was on large businesses, companies with 50,000 crores plus in market cap, I'll definitely encourage you to try out other variations like 20 to 50,000 crores for mid caps and below 20,000 crores for small caps as well. Okay, so other than market cap, SOIC's GARP framework includes an year-on-year quarterly sales growth of 15%, and year-on-year quarterly profit growth of 20%, and thirdly, a P multiple of less than 30. This query resulted in 16 entries, most of them being banking and NBFC stocks. But because backtesting is not available to me, I'll not be analyzing this list now, but I'll definitely do it next year when I come up with an updated video. Now, I'm not sure if you've noticed this, but Ishmohit's methodology does not use the PEG ratio, which was frankly a bit of a surprise to me. But then I populated his query across all companies which had a current market cap of over 10,000 crores, and pleasantly, of the 47 stocks it yielded, 29 of them, a good 62% of them had a PEG ratio between 0 and 1, and another 21% of the stocks had a PEG ratio between 1 and 2. I'm sure you're curious to know if SOIC's GARP method managed to beat the 113% or not, and I regret to inform you that they lost this battle by a good 3%, and their framework could only manage a 110% return over the last 1 year. The third GARP methodology I explored was on the basis of something I read in the Economic Times exactly a year back. So in this case, the selection of GARP stocks was based on a 6-point criteria that included the market cap that has to be over 1,000 crores. The sales revenue also should be over 1,000 crores, so that's another new variable for us. The model requires a 5-year profit growth of at least 15%. The expected future profit growth should be 15% or more, so another new variable. We then need a PEG ratio of less than 1, and there should be a minimum of 5 analysts covering this stock. Now, I'm not sure how many of these criteria have been specifically created by ET to sell their research product, but barring the last one on the number of analysts, I'm sure the rest of them can surely be put on a screener, including the fourth point, where using a small tweak in the criteria, we can forecast if the next quarter's profit will be at least 15% higher than what it was a year back. Again, nothing's perfect, but when put on a screener, this query yielded me 131 stocks, which I think is a bit too much, which is why I'll encourage you to mix and match some of the other variables we've learned previously in the video. Anyways, and just FYI, I also examined the 1-year performance of the 10 stocks that the Economic Times framework had put forth in their article, and the small portfolio gave me an annual return of 51%. The last GARP strategy is a documented one, and it is not made in India. In fact, there's an index named the S&P 500 GARP index that tracks companies that adheres to S&P's definition of what a GARP stock looks like. Now, I won't go into the methodology, universe, constituents, etc., but I'll spend a minute on the 5 factors they use to see if we can find something useful here. So the S&P 500 GARP index has a couple of growth variables, and it's pretty straightforward with the methodology opting for a 3-year EPS growth rate and the 3-year SPS growth rate, where SPS stands for sales per share. Additionally, the GARP index also uses a few quality and value composite factors, such as the financial leverage ratio, which is calculated by taking the company's total debt and dividing it by the company's book value. Then there is return on equity, which uses the company's 12-month trailing EPS and divides it by the book value per share. And finally, there's the earnings to price ratio, which is simply the 12-month trailing EPS divided by the stock's current market price. You can get more specifics in the S&P Global website, and I've anyways added the document link in the video's description, but my objective of mentioning it here was for us to get a better appreciation of how different metrics and variables can make up a GARP strategy and why it's important to find a proper balance. So that was something interesting to conclude our 4 examples, and I hope you now have a better understanding of GARP and have enough ammunition in your arsenal to create your own GARP strategy. But let me not keep you hanging there, and if I have to design a GARP investing framework myself, Then I'll definitely have a capping on the market cap, so nothing below 1000 crores. I also like the idea of having a minimum level of sales, which I'll want to keep it at least 1000 crores. The PEG ratio is super important, and I'm okay with anything between 0 and 2. As we learned from the S&P GARP index, we want companies whose sales are growing. So I'll want to see a 1, 3, 5-year sales CAGR of at least 15%. The EPS also needs a similar setup, so a 1, 3, 5-year CAGR of 15% or more. And finally, let's add a dose of expected profits by ensuring the next quarter's earnings are higher than the last year's. So plotting this as a query on Screener gives me a list of 27 companies, and as one might have expected, the sales growth and the growth in profits are high. The P ratio is all over because unlike SOIC, I went with the PEG ratio instead. Surprisingly, there are not many banks in this list. I also looked at the ROC, the return on capital employed, and this is mostly in the 15 to 25 range. The average promoter holding comes to about 55%, which I think is ideal. Most companies are using debt to grow, and the interest coverage ratio is comfortably above 3 in most cases. And I was happy to see the spread in sectors in this list, which was wide and diverse. You can access this list in the worksheet I've attached as a link in this video's description, and feel free to build on the query, which is also available in the same worksheet. Finally, if curiosity is bubbling inside you on how these 27 stocks would have performed, then I'm happy to report that this custom GARP portfolio would have delivered 115% in returns over the last 1 year. So it was surely a very tight three-way context, but in the words of Dubeji,
रामलाल जी, आज मैं भी मान गया, जो जीता वही सिकंदर.
nah, I think Sanju, Shankar, and Ratan all did pretty well in that cycle race. So do try out the GARP cycle, modify it, track the results. Remember what I said earlier, the objective here is not to find cheap companies, but to identify companies whose growth has been underpriced, and always keep a long-term perspective when employing a GARP strategy. Once again, thank you for your time. Do subscribe to my newsletter if you haven't done that yet. Share this video in your WhatsApp groups, and I'll see you very soon. Until then.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.